Just as many mission-driven fund managers have reconsidered their defense policy in the wake of Russia's full-scale invasion of Ukraine, an analyst at Goldman Sachs says it is now time for sustainable investors to reevaluate their approach to oil and gas companies. It comes at a time when European energy majors have slashed renewable spending and doubled down on fossil fuels in an effort to boost near-term shareholder returns. Investments focused on environmental, social, and governance (ESG) factors tend to favor companies that score highly on certain criteria, such as climate change, human rights, or corporate transparency. Tobacco giants, fossil fuel companies, and weapons makers have typically been among those to have been screened out or excluded from sustainable portfolios. In the same way that the sentiment on defense companies has changed with the Russia-Ukraine war, I think the sentiment on ownership of oil and gas should change. Michelle Delavigne, head of EMEA Natural Resources Research at Goldman Sachs, told CNBC by video call. A persistent unwillingness to own energy majors is biased by a major mistake in evaluating the energy transition from the perspective of European investors, Delavigne said, an approach that he expects to change. Goldman's Delavigne outlined 3 reasons to back up his view on why ESG investors should bring oil and gas stocks in from the cold. Let's be clear, this energy transition will be much longer than expected. We are going to have, we think, peak oil demand in the mid-2030s and peak gas demand in the 2050s, Delavigne said. And we clearly show that we need greenfield oil and gas development well into the 2040s. So if we need new oil and gas development, why wouldn't we own these companies? The International Energy Agency, meanwhile, has said it expects fossil fuel demand to peak by the end of the decade. The energy watchdog has also repeatedly warned that no new oil and gas projects are needed to meet global energy demand while achieving net zero emissions by 2050. Delavigne's second point was that oil and gas companies represent some of the biggest investors in low-carbon energy worldwide, adding that a failure to both engage with and finance oil and gas stocks would ultimately serve as a barrier to the energy transition. In addition, Delavigne said that unlike utilities, which he described as infrastructure builders, oil and gas companies are market makers and risk takers. So we need their capabilities, the balance sheet, and the risk-taking. They are some of the largest investors in low carbon, and whether we like it or not, we also need their core businesses of oil and gas, Delavigne said. Otherwise, we will not have affordable energy, especially for emerging markets, and we will have energy poverty, which I don't think is acceptable in any ESG framework, he continued. I think the energy companies that lead the energy transition should be a cornerstone of ESG funds, not a divestment target, Delavigne said.